your mic on.
He's a good guy.
Which is that.
Okay, it's 10 o'clock. Thank you, everyone, for attending. Just call the meeting to order. First order is approve the minutes of the meeting of June the 9th. We have a motion and a second. Go ahead and vote.
It's okay.
Okay, that passed. The second item is, Regina, would you come and introduce our actuary?
Yes.
On the consent item today, we have our 12/31/21 actuary report, and Louise Gates from GRS is here to give a presentation. So I just wanted to make sure we did that before we voted on the consent docket.
Okay, thank you, Louise.
Good morning, everyone. Can everyone hear me okay? Kind of? Let me try. Testing this. Better? Okay, great. It's good to be here today and to have this opportunity to share with the board the results of our work. And for the purpose of this presentation, the most recent actuarial valuation of your pension plan as of December 31st, 2021. So the actuary's job is to measure the liabilities of the pension plan. And based on that measurement and the assets held in trust, we can determine the amount of city contributions needed that, when coupled with future investment income, will be sufficient to fund the obligations of the system. And one of our main findings in this report is shown on page A-2. So we do our calculations as of what we call a valuation date, which is just a calculation date. And for the purpose of this report, it's December 31st, 2021. But these calculations and city contributions correspond to a future budget year, namely the one-year period ending June 30th, 2024. So that lag time enables the city to have some time to budget for the contribution requirements. And so you see a lot of numbers on page A-2. That's because city contributions are expressed as percentages of pay. It's a contribution procedure. The rates of pay shown on this page are applied to payroll during the 23-24 fiscal year, and that enables the city to make contributions that are fairly precise. You know, the alternative would be to project pay for the period and give you a dollar amount, but what the city is doing, I think, is probably more precise because it's based on actual payroll. Looking at the very bottom chart, the city contributions for fiscal year denoted FY24 versus FY23. Looking at the very last row, the city contributions in last year's report were 6.46% of pay. This year, you can see that they're lower by about 2%. And the reason for this has to do with the favorable experience of the plan, in particular, the great investment performance during calendar year 2021. We make assumptions about future levels of investment income. We have to do that in order to measure the plan's liabilities. So to the extent that you're getting more investment income than what's projected, it lowers our assessment of system liabilities, and then by extension, city contributions to the fund. And that investment return and other information is shown on page B as in boy -3 of your report. So again, this is for calendar year 2021, and you see member and city contributions coming into the fund of over $18 million. And you see investment income of over $125 million. A great year for the pension fund. You have other sources of revenue that are not related to investment income. And benefit payments totaling over $42 million. Your retiree population is growing, and so the benefit payments would grow, correspondingly. So overall, system assets grew in 2021 by over $98 million, which is, excellent growth. But as many of you know, we don't simply use the market value of assets in the work that we do. We don't use that to determine city contributions. Doing that would create a lot of contribution volatility corresponding to capital market volatility. On page B-4 of your report, we show the development of assets that we use to determine city contributions and other information shown within the report. So page B-4 shows what we call the development of the funding value of assets. It's a smoothed asset value, and the result is different, of course, from the market value because it phases in what we call investment gains and losses, which are differences between projected or expected rates of investment income and what the fund actually earned. So items B and C show the market value of assets at the beginning and the end of the year. And this is how most people think of asset values, the value of securities held in trust. Non-investment net cash flow on item D are mainly contributions coming into the system and benefit payments leaving. It's what's happening during the year that's not related to investment returns. Item E is kind of interesting, or maybe it's only interesting if you're an actuary, but it's the market return for the year was over $122 million when we subtract off the investment and other expenses. What we projected based on long-term investment return expectations was $56 million. So that difference, which is over $65 million, is what's getting phased in. And that's shown in item F. 25% of that is over $16 million. And so we end up with a smoothed asset value at the end of the year of over $878 million, which you can see is lower than the market value. It's lower because we're holding back some of the investment experience over the past 3 years. So what's good about this is if in 2022 your investment returns are lower than what's expected, you have these investment gains that are sitting here that will be used to offset potential investment losses in 2022. Now, of course, 2022 hasn't ended yet, so we don't know what your investment experience will be. But if it's lower than the assumed rate, you'll have investment losses, but they will probably be offset by the investment experience that you have sort of pent up that has not yet been used. But overall, a great year for the system, a rate of return, again, of over 14%. But in addition to the great investment experience, which was probably the biggest driver of the reduction in liabilities and contributions, on page B as in boy -8, we also have a 20-year history of what we call active members, which are the employee members of the system, and some information about payroll and average pay. And so if you look at the very last column, you can see that the increase in pay, average pay, over the prior year was only about, 1.1%, which is lower than long-term expectations. So to the extent that pays are not growing as anticipated, it means that our assessment of retirement benefits in the future is lower, which means our liabilities are lower than what they were in the prior year. That's another reason, smaller in magnitude, for the reduction in city contributions. And on page D, like, daffodil -1, we have this summary of, we call it the schedule of funding progress. It's really a summary over the last 10 years of system liabilities, system assets, and then the difference between those two numbers. So with respect to the most recent valuation, the accrued liabilities of the system were over $851 million. So this is the value in today's dollars of all the benefits that have been earned to date by employees and retirees in your system. But when you compare that to the assets at the same point in time, the assets are $878 million. So you have more assets held in trust as of the end of 2021 than you have liabilities. And so as a result, you have what's called a funding surplus of over $27 million, which is certainly good news. And your system's funded ratio, which is probably the most common metric used to measure the financial strength of the retirement plan, is over 103%. So for every dollar of liability, you have $1.03 in assets. Certainly an excellent position to be in, and I think from the perspective of many public plans, an enviable position to be in. There are many plans that are struggling to get to 100%. But I think even more importantly, when you look back over the last 10 years, the funding percent in this system is high. It's not like you're struggling to get to 100% funding. And that really speaks to the good decisions made by the city and by this retirement board and prior retirement boards. So overall, a great year for the system. And that concludes my prepared comments, although I'm happy to answer questions or talk more about the really cool actuarial things happening in your plan. Although I realize most people find our work to be far less interesting than we do.
Yeah, I just have one comment and also one question. A very good presentation. You make it actually, I think you do a better job than you think. It sounds really good, and I am interested in what you do.
Thank you.
I actually like it. I had a question, or really maybe an observation about what we could expect in the future with these valuations. If I understand it right, it's somewhat lagging. So right now we've had some good years. A lot of talk nowadays about recession. We're not there, but there's things happening to try to control inflation, which maybe we don't have that soft landing that we would all like to have. So my expectation would be that if foreseeable that does happen, going forward, we're having worse returns. We're not having really good returns right now, but that would continue on and maybe get in a recessionary area, how that might affect. And what I would like to do, if Regina, if maybe you could go to A6. And in the center column there where the established city contribution rate of incentive active member payroll, I've looked back at, say, the year 2007, 2008, and pretty tough times during them years. And we saw how in 7 we had a 5% contribution That's lower than we're actually in a good range that we would like. But an 8 is starting to grow on us, 9 is starting to grow on us, 10, we almost hit our cap at 10%, and then it started running back down. Is it unreasonable to expect that with the average of the valuation method that we have, that should we go into a recession and starting seeing the returns starting to affect us, that we would see something similar to this, where right now we're lowering the city contribution, but conceivably we could see that go the other way if, and I know this is a big if, but if we were to go into a recessionary period.
Right, so I guess my compliments to you for a thorough reading of the report. I have to say it's probably about 10 or 20% of trustees that, sometimes more, that read it with such enthusiasm, so thank you. So it's an interesting page that you're citing because, as you know, 2008, we had the start of the Great Recession. We are using an asset smoothing method, and so what you can see is that the impact of that it's sort of a slow increase in contributions, and then we see the beginning of a recovery starting in about 2011, 2012, and the contributions start going back down. So certainly it's possible that you could see something similar happen in the future if you have a protracted period, maybe 2, 3, 4 years of low market returns. But the smoothing method helps to mitigate those spikes in city contributions. And I have to say, I've always been impressed by the city's commitment to make contributions historically even in excess of that 10% cap. There have been times over the past 20 years that I've been involved in your plan where that has happened. And so, again, the financial position that you're in currently really speaks well to the city's commitment to funding this plan and the good decisions that this board and prior boards have made with respect to funding the obligations of this system.
Yeah, thank you for that. And before we tap or pat ourselves on the back too much as trustees, actually, I guess it was in 2006 or so that it was put in our ordinance that whatever is adopted in your report is actually what we have to do. So it's really been taking that decision out of it. And there's good and bad with that. I would say maybe the downside is in a period like we're in right now where there's some uncertainty as to what future markets would look like, it would be kind of nice to leave that pad in there rather than dropping it right now. Maybe leave that pad in there in anticipation of things getting worse and get a head start on it. But on the upside of that is it takes out any political type things or discussions about, the city's needing some more money for operations, and so we want to hold back on those contributions on the city portion of it. They don't have that option to do that. It has to be what comes out of this report. So good and bad on both sides, but I just wanted to mention that actually we don't have a say on whether or not we change what your recommendations are on here. They will be there.
Right. So I'm thinking in terms of things like the experience study. We present a couple of different options for future rates of investment income. And, in some cases, retirement boards, and certainly not this one, there's like a stubborn refusal, really, to change something like the discount rate. Mm-hmm. And again, it goes back to what you're saying. Well, there's this city project that we want to fund, and by lowering the discount rate and raising our assessment of liabilities, that takes money away from this other project. Yeah. So, again, in my experience with this board and prior boards, you've always made good decisions.
I do have one last thing, a suggestion, and this gets easier now because it's an easy suggestion. on this, I would recommend if there's a way, somewhere in that C section where we have definition of terms, of including a definition of the actuarial value of assets. And because it's in there, and you've got a very good detailed presentation of how we calculate and that get there. But I look at this one time a year, and I always have to retrain myself, what does that term mean? And I go and Google it and look it up, and I go, oh yeah, that's what it is. But I was looking for it in this year, to see what is the definition of that, and couldn't find it. So that's just a suggestion, not a demand, but I would just say, if it could be squeezed in there, I think it'd be a good term to have.
I'm sorry, I want to make sure I understand the suggestion. Is it to replace the title actuarial value of assets to funding value of assets?
Well, possibly, what you said, actuarial value of assets?
Right, instead of maybe asset valuation method? What would you like it to read? This can certainly be done.
Is that one that's already in here? Is that what you're saying? Or are you just wanting clarification on the title of it?
Yeah.
Well, the term that I was seeing that triggered this thought when I was reading it was the term actuarial value of assets. So, and that's something I find. I mean, that's what you can go out and Google, and you can actually find the definition of it. But something along that lines that would just in a paragraph kind of define that versus say what a market value approach to that would be. But I wish I could be more clear about this, but I'm just really kind of looking for something that would define that. So when I'm reading it in the pages up ahead, say in section A or even in B, if I, once again, my short-term memory, lose track of what that meant, I'd have a quick reference to it. This is a very minor thing, so I'm just bringing that up, like I say, as a suggestion.
Okay, I'll see what I can do.
All right, thank you.
Thank you.
That's all I have.
Okay, any of the trustees have any additional questions?
My pleasure.
So I think we can take these all as one, which would include the approval of the actuarial report. We have a motion, we have a second, so let's have a vote.
Trustee Lawson, how do you vote?
I can't seem to get off of the
You can-
presentation mode when I click
You can
on
just
it.
tell me your vote for this one.
I approve, yes.
Okay, that passed. Next item. Is to ratify the approvals, number 4. Do we take that all at once? Okay, this is an all-inclusive item. Ready for your vote?
Trustee Lawson, how do you vote?
Okay, we've got it resolved now.
Okay, the item passed. Okay, we're on item 5 now. Approve the claims docket. Is there a motion and a second? Okay, record your vote.
Oh, hang
Okay, the item passed.
on. Hang on one second.
Wait a second.
I missed your vote. Trustee Madera? Yes, okay. There we go.
Okay, the item passed. Let's go to number 6. We have approval for the following service applications. 1, 2, 3, 4, 5, 6, 7 of them. There a motion and a second? Record your vote. Okay, the item passed.
Trustee Madera, you vote aye.
Yes.
Something's going on with her.
Okay, I'm getting a little premature. Okay, we go to number 7, receive report of death, authorize payment of $5,000 death benefit, and approve continuation of pension to spouse. We have 2 items. Record your vote.
Vote aye.
Aye.
Okay, the item passed. On item number 8, receive report of death, approve a continuation pension to spouse. We have 2 items. Record your vote.
Aye.
Item passed. Go to number 9, receive report of death, authorize payment of $5,000 death benefit, and authorize secretary to make necessary changes to conform to the following. We have 1, 2, 3, 4, 5 items. Record your vote. Item passed. We go to number 10, ratify approval of requests of the following to terminate vested interests and commence retirement benefits. We have, looks like 1. We need a second. Thank you. Record your vote. Okay, item passed. Go to number 11. Ratify approval of the following to terminate vested rights and receive a lump sum distribution of his/her employee contributions account. We have 1 item. Record your vote. Item passed. Okay, we go to number 12. Jason, you're up. Receive monthly investment report.
Okay, thank you. I handed out a additional piece, just a market update that I wanted to walk through. I anticipate there'll be questions about if we're having a recession or going to go into a recession, and I'd say we probably are already in a recession. And regardless of that, we recognize that markets go up and down over time, and it's really important for pension trustees and stewards of long-term capital that are investing assets to cover long-term liabilities to think about the long term. And you put together a thoughtful plan from the asset side. That's your asset allocation. We recognize that you have to take some risk to achieve your required rate of return over time. And with that, there's a probability, and when we do asset allocation work for you every year, I'd say based on your asset allocation or the typical asset allocation for a long-term investor, roughly 65% equities, 20% in fixed income, and 15% in real estate, there's about a 20% chance in any given year that you're going to have flat to negative returns. And so that's a one every 5 years, roughly. And we're there right now. How long this lasts, we've seen it before. We'll get through it. It's painful as it's going on, but I think it's important to keep in mind that plan and that long-term strategic outlook. So what this piece we put together, though there's some comments on the first page, this is one of the worst drawdowns or declines in the market for the first half of the year in decades. I think one of the things that's made it particularly challenging is that we're seeing fixed income down alongside of equities, primarily as a result of rising rates, and that's been within treasuries. In the financial crisis, we did see fixed income, primarily credit, down, whereas treasury values were up. So if you owned U.S. treasuries, those went up because we saw rates plummeting during that time. This is I don't want to call it unique, but it's different than what we saw in 2007 and 2008 because we're really trying to stave off inflation. And if you look at the next page, I'm sorry, I'm looking at this handout, Regina. It's you don't have it electronically. To me, this is a great chart. This is looking at the S&P 500 going back to 2019. It looks like this. It's like this trend line. And what you'll note, if you look at in March of 2020, that was the trough of COVID, where you saw the S&P 500 trading at about 2,200 was the value. Today, this morning, the S&P 500 was at about 3,725. So from that point in March of 2020 till today, we're up about 1,500 points. So that's still a pretty good return over that period of time. It feels really painful from what we've experienced the last year to date. On my handout here, I've circled a few things. March 12th, Fed cuts rates by 50 basis points. March 15th, 2020, Fed cuts rates by another 100 basis points. March 24th, 2.2 trillion stimulus plan announced. December 21, 2020, Congress passes $900 billion stimulus. March 11th, 2021, Biden signs the $1.9 trillion American Rescue Plan. We were in a very precarious time, didn't know what was going on, and basically what you saw happening was lighter fluid or gasoline being thrown on this to get this fire stoked. And it really did stoke things for the next 2 years. And now things are still running a little bit too hot. Couple that with continued COVID lockdowns in China with creating supply chain issues, and then the Russia invasion of Ukraine creating issues with oil or energy and food prices. We're kind of in a bit of a dilemma where the Fed, not just in the U.S., but outside of the U.S., is having to fight inflation at a time when it's somewhat tricky. So now we're trying to cool off what we've created over the last, really, that's a lot in the last 2 years, but it's really been the last decade of very low interest rates. As a long-term investor, and Louise talked about it with your funded status, you're in a very good position coming into the end of this year. It wasn't just 2021, it was 2020 and 2019 were good years. But that's why, from an accounting standpoint and actuarial standpoint, you smooth in those gains. You don't recognize them all at once because we know there's going to be years like this where you're going to need to smooth in the losses from this year, most likely, and offset that with some of the gains that you've seen. Go forward a couple of pages in this handout, and this is a chart that I showed you a few months ago, just looking at market drawdowns and that they're common, but what we hadn't talked about is looking at the recovery afterward, and that's the table at the bottom. So just as a reminder, what this chart is showing is going back 40 years, looking at the S&P 500, and basically, on average, every year, we have at least about a 14% drawdown. That's been the average drawdown intra-year. Most years are positive. There have been a handful of negative years, some worse than others, 2001, 2008, and now 2022 is looking like that, where we are today in July. But if you look at the table at the bottom, this current period, at least for the S&P 500, some markets we recognize are down a little bit more, small cap and international down a little bit more. But through the end of June, the S&P 500 down about 20%. The length of this drawdown has been about 6 months. It started, the peak was December of 2021. We indicate here the valley in June of 2022. Not sure if that's the bottom. We have seen markets come up a little bit in July. We're not trying to predict that as the bottom. But what we're showing here, in past periods where you've had these significant market drawdowns, once we hit that bottom, the return following that has been pretty robust. So this is just another reminder of why we need to stick with the plan. We don't try to abandon things and time the markets, sticking with our knitting and moving forward. The next page, I do think is just an important reminder for long-term investors. If we look down in the lower left here, these are our capital market assumptions. This is a chart that's in this piece every month, but this is a little bit different. What we're showing here in the purple is if we redo our capital market assumptions once a year, and it's typically in December for January. And as a reminder, our intermediate term assumptions, so these are our 10-year forward-looking assumptions that we talk about, but those are anchored more on current yields in the market, so for fixed income, and current equity valuations. Our long-term assumptions that are looking out 20, 30 plus years that are more relevant for pension funds, those are anchored more on long-term historical averages. But the last several years, we have been coming to you and saying we expect more muted returns. The expectation for this portfolio, while you've been very aggressive, and better way to put it is, you've been very conservative in thinking about your assumed rate of return relative to peers. You've lowered that down to 7%. I think the average for public pension funds, based on the most recent survey data I've seen and from NASRA and CPRS, is a little under 7.25%. Louise can correct me if I'm wrong, but I think that's about where most public pension funds are. You've been conservative in bringing yours down to 7%, which we think is reflective of what our expectations have been going forward. And when we looked at intermediate term expectations for your portfolio coming into this year, it was probably closer to 6.5% over the next 5 to 10 years. That more like 7.5% as we look out over 30 years. What this chart in the bottom left is showing, the purple, that's our expected increase to our capital market assumptions if we were to run this mid-year. Why is that? Well, that's because of what's happened. Interest rates have gone up. While that's been painful throughout the first part of this year, the expectations for bonds now going forward are better than they were a year ago or 2 years ago because yields are higher. The same for equities. We came into this year, last year, and the year before with equity valuations being very high, coming off 10 years of very accommodative monetary policy, pushing up equity valuations, making it, we had a 16% annualized return for 10 years on the S&P 500. That's about 6.5% above the long-term historical average. That has to come down. It's come down quite a bit now. So going forward now, if we look at our large cap assumption, it's gone from right about 6 to closer to 7.5 for if we were to run this right now. So my point is, as a long-term investor, assuming your time horizon is longer than the next 6 months or a year, things are looking a little bit better for the next 5 to 10 years today than they were 6 months ago, a year ago, or a year and a half ago. That's not to say that we're out of the woods yet. This is going to continue to be a challenging environment, but hopefully this provides a bit of perspective. As we look at your portfolio, the market value at the end of June, a little over 800 million, 813 million. So really at the end of the year, the market value was 978 million, so down about 160 million from the end of the year to now. And that's reflected in that year-to-date return. You're down about 14%. Let's go back to the first page. From an asset allocation standpoint, really reflecting what's happened in the market. Equities down quite a bit. We're a little bit underweight equities now. Still slightly overweight large cap, but underweight large cap and small cap US. We came into this probably with a little overweight there. The areas that have done a little bit worse are a little bit more underweight. It's been a little bit more challenging from a rebalancing standpoint operationally because both equities and fixed income are down, and real estate has held up fairly well because it's not mark to market on a daily basis. We expect to see some slight write-downs in real estate portfolios in the coming quarter, but that's now slightly overweight. From an operating need to pay your monthly benefits, we can't take money out of real estate on a quick enough basis to rebalance, so we're still having to kind of balance that between equities and fixed income, where to take money from. Just looking at from a return standpoint, as I mentioned, year to date down about 14%, roughly in line with the policy index, about right on top of that on a gross basis, a little bit less net of fees. If we look out 3, 5, and 10 years, while those numbers have come down, still outperforming your policy index. And I'd say that 5-year 6.8% return is probably more in line with what we've been projecting from an asset allocation standpoint the last couple of years, coming into, as we were looking forward over the next 5 to 10 years, and now we're seeing returns in the short term bringing those down. The biggest headwind, and I've talked about this the last few months, within your large cap portfolio, which is your largest allocation, while you are primarily passive with the SSGA fund and then Intech is an enhanced index, that Intech strategy tends to overweight some of the smaller names in the large cap index based on its approach. It's more equal weighted. And that, in the first part of this year, that was a bit of a headwind, and that's where you see some of that dispersion relative to the policy index. Long short equity has been a challenge. This month, however, we did see quite a bit of protection where markets are down. The ACWI global equities are down 8.5%. Long short equity was only down 3.8%. The trailing 1 year, certainly disappointing. We've talked a little bit about that. Some of that is due to these long short strategies not up as much a year ago when some of these no earnings, low quality companies were performing well in the long only benchmark. But more as we look at the total construct of that portfolio, which is a portfolio of multiple managers, about 12 managers, a little bit more exposure to smaller cap, once again, just like the Intech strategy, and a little bit more exposure to growth names. We are planning to come back to you next month with a plan to rejigger that portfolio a bit, make some redemptions from some of the underlying managers, and some rebalancing to reconstruct that portfolio a little bit to take out some of that growthier bias that really wasn't helpful, and I'd say less intentional. So that's something we'll talk about next month. Private equity has done well. You've gotten a nice return from private equity. Last year was a very strong year for private markets. Again, these aren't marked to market on a daily basis, so a bit of a lag there, but providing some protection. International equity, not disappointed, this has been a challenging year on multiple fronts. Just the same issues we're seeing in the U.S., slowing growth, challenges with inflation, impacting non-U.S. markets as well. Another big factor here, currency, the impact of a strong dollar. The dollar has reached its peak value versus the euro. They're now equal for the first time since 2001. As the dollar strengthens, if you're a U.S. investor investing in non-U.S. securities, when you sell those securities to buy back dollars, it costs more. And so a strengthening dollar can be a headwind in this period, and that's what we're seeing here. On the fixed income side, now more recently, we've got a bit of an overweight, and we have to Core Plus, the Western strategy. Longer term, that has helped us, and we still think going forward it will be a benefit, but there's more credit exposure there, and as spreads have widened out a little bit in the last few months, that's been a bit of a headwind. That said, the liquid absolute return strategy, which is the newest strategy that you've added, that's the PGIM, Prudential absolute return. On a one-year basis, that's down 2.7% versus the aggregate benchmark down 10%. So that's doing what we would expect it to do. Finally, real estate, you'll see your real estate portfolio, very strong, 24% return. The other item I had today, just a reminder because I wasn't here last month, when I was here in May, we had talked about Times Square, who is your small to mid-cap growth manager. Actually, their performance has been fine. It's pretty much been ebbs and flows, but it's been in line with expectations. However, there's been quite a bit of turnover in that team. From 2018 to 2020, they had 4 analysts on that team leave. And then just earlier this year, it was announced that one of the founders of the firm and the co-portfolio manager on your strategy was going to be retiring in 2023. That precipitated the loss of some assets. They've had a number of clients redeem, and they lost about half their assets in the strategy, went from about $2 billion to a little under $900 million. So that's caused us some concerns, and we'd like to review other candidates. So this morning, we haven't done this in a while, where we've evaluated a long-only manager, maybe since some of you have been on the board. I know since Matt's been on the board, I'm not sure about Amy or Marty. Typically, they've been private market strategies, where in private market strategies and closed-end real estate strategies, it's more of a rifle shot with a recommendation on a fund. With traditional long-only managers, so your large cap, small cap, fixed income managers, historically we've done it through a review process where we bring a couple of 2 or 3 candidates to the board, and the board generally interviews those candidates and makes a selection. So I'm just prefacing that because it's a little bit different than what you've all experienced since you've been here. So this morning, we're not selecting a manager. These are the candidates that we've whittled the field down to that we think would be a good complement in your portfolio and complement Ernest on the small to mid-cap value side well. And I'll just give you a few high-level comments on these. If you'd go to that page. So Loomis is a large firm. They have 330, almost 40 billion in assets across a multitude of strategies. This small cap growth team and small to mid cap growth strategy has about $2.5 billion in assets. It was started in 2012. It is like most small cap strategies, it's a pure bottom-up strategy, meaning they're doing security level research and building their portfolio from the bottom up as opposed to taking some top-down macro view on things. Typically, fairly well-diversified strategy, 65 to 85 securities in that portfolio, which looks a lot like Times Square, and it will go up into mid-cap some. The Riverbridge strategy firm back up a moment. Loomis is a public, it's 100% owned by Natixis, which is a public company. Riverbridge ownership split between a private equity firm and the employees, about $13.2 billion in assets overall for the firm, so well capitalized. This strategy has about $3.7 billion in it. And one of the reasons I mentioned that is we narrowed this field down and looking at other managers, one of the considerations that we talked about, there are some other managers that we like, but they've gotten pretty big in the small cap strategy, some of them as much as 10 to 15 billion in assets, and we remove those from consideration because it's very difficult in small cap. We're looking for a manager to manage small cap assets for you. Once their asset size gets bigger and bigger, it's hard to keep them kind of ring fenced within the small cap universe. They start moving up in capitalization. So that's why that's an important point. This strategy goes back to 2006. Again, bottom-up growth, a little bit more concentrated, 40 to 55 names. And then the third firm is Silvercrest, formerly Cortina is what they were called. This is, they're based in Milwaukee. All they do is small to mid-cap strategies. They're dedicated to that. As a firm, about 23 billion. This particular strategy, relative to the other two, this is pure small cap, so not going up into mid cap, and about 600 million in this strategy. And they do a little bit of top down from a sector standpoint, evaluating certain sectors, but still pretty bottom up approach. If you go 2 pages forward here on the market cap, you'll see, what we're really looking at here. For small cap, we're really thinking this is 5 to 7 billion and under. If we look at the Russell 2000 growth benchmark, the grayed areas is the 3 largest allocations. So for small cap growth, 24% roughly of the Russell 2000 growth is under 3 billion, or 1.5 to 3 billion. 31% is 3 to 5 billion, and 17% is 5 to 7 billion. You'll see the Russell 2500 growth, which goes up into SMID a little bit more. You drop off about 10% of the smaller end, and you add a little bit more in the 7 to 10 billion, which is a little bit more mid cap. As we look at these 3 managers, they fall out as we would suspect, with Cortina being the more small cap manager. Now this is where we want to talk, or all we really want to do today is decide who you want to interview, how many you want to interview. Historically, you've interviewed either 2 or 3 managers. I think 2 is sufficient, just because you start to get it. It's, hopefully all the managers we're bringing to you, we think they're all quality managers, and we'd be comfortable with you selecting any of them. It really gets down to fit and kind of differentiation when you're talking to them. Ernest, let's go to page 14. So here we're just showing kind of the combination relative to not the value or growth benchmark, but just the small and mid cap benchmarks, the core markets from an asset allocation standpoint. This is what we're really trying to deliver. So just a reminder, a description of Ernest. Ernest is your small to mid cap value manager. Ernest, we would describe as more of a relative value manager. So they're not gonna, in periods of time where deep value is really doing well, they're gonna lag. That's why they really look good relative to value managers the last dozen years or so, as deep value didn't do as well. They're also going to move up in cap a little bit more into the mid cap space. So as we look at these combinations as to where we are with, this is a 50% Loomis, 50% Ernest, so really what it would look like at this point in time. With Riverbridge and Ernest, you've got a lot of the lower end of large cap exposure, almost 25% greater than 15 billion, almost 30%, 10 billion and above with that combination. With Loomis and Ernest, it's a little bit lower, and then with Silvercrest, because it's a pure small cap manager, it's a little bit lower. So all of that said, I'm pointing this out, I think to get a differentiation of a couple of managers, if you were to interview 2, I would recommend Loomis and Silvercrest as 2 to consider. And the next step would be they would come in and present to you, and then we would make a decision after that. So again, I don't want to get too bogged down going through performance. The performance is good for all of them. They're going to look a little bit different and give you a little bit different kind of risk-return profile, but at this point, that would be our suggestion for the next meeting, or if you have time at the next meeting.
No, do we?
What was your question? Sorry.
Say the question again.
The question is really how many, do you want to interview 2 or 3? If you were to interview 2,
Not taking a vote today.
right, I don't know that it's a vote, it's just giving us direction as to who to invite in. Are you comfortable with us inviting in?
What are
those
you
2?
comfortable with?
I would suggest interviewing Loomis and Silvercrest.
Okay. The first thing we need to do is any questions about the monthly investment report? If not, do I hear a motion to receive? Okay, record your vote.
Trustee Thurman, how do you vote? It's okay.
Okay, the item passed. On the presentation next week, or next month, you're recommending 2.
Well, I think, in our view,
50-50.
trying to have 2 to compare, they would be more different. Riverbridge and Loomis are more alike in that SMID, and Riverbridge really goes up in market cap. So when you combine that with an Earnest, you're going to have quite a bit of mid-cap exposure. We think Silvercrest is a little bit different profile.
Well, they're different than Loomis, but on the risk return, it looks like Riverbridge is when you mix it with Earnest, is better.
Yeah.
Page 18.
Yeah, for sure, the Silvercrest has been the highest. It gives you a little bit more juice in terms of return, and we really think of small cap growth, much like emerging markets, is an area where we're really trying to seek return. This is a 5% allocation. If you look at where Silvercrest is at least on a 5-year basis, it's a higher return, and it's not much more risk. Just distinguishing between those 2, Loomis and Riverbridge look a lot alike. And so I'm suggesting 2 that look a little bit more different.
Okay.
Yeah.
Okay, other questions about the small mid-cap discussion?
Yes, I had a question for you. Back over here on page 7.
Surprise.
I was looking at where the category breaks are as far as market value for the large, mid, small, and micro areas. And just what I found, and help me out with this, it looked to me like Loomis and Riverbridge were a little bit drifting out of the categories, as though they were heading up into more in the territory of large cap in some of that. But I may not have it right on where the
That's not
breakdown
large.
is.
Don't think of this as large cap. Greater than 15 billion is the high end of mid cap and
Okay.
very low end. I mean, they're not. If we're looking at large cap, this is 100 billion and up.
Okay.
Your median market cap on your large cap managers is, the average market cap and median market cap on your large cap managers is going to be closer to 100 billion. So
Okay, I
this-
think that's what
Yeah.
helps me there is the
Yeah.
the data that I was looking at would have large starting out somewhere around 10 billion. Probably what we could say is what you've got on the scale over here on the left, where that's probably our range for mid-cap then would be within.
So if we look at the Russell 2500 growth, there is, in the benchmark, there's about 10% that is greater than 15 billion
Okay,
in that small to mid-cap benchmark.
okay.
So-
So what I can take from that is these three companies that you provided are reasonably within
Right.
their categories.
And
They're
the-
not drifting out of anything at this point.
No, but to Randy's question, if we're looking between Loomis and Riverbridge, Riverbridge has quite a bit in that greater than 15 billion. So we're trying to think what's the best fit in our portfolio and making sure that we're getting that really small to mid with the combination of Ernest and whomever we choose. We're leaning toward these managers that haven't drifted too high up.
Yeah, and I see your strategy there. Randy, I take your point well. I was leaning towards, let's look at two, but you make a good point. Maybe we should look at all three. Okay. One last thing. There are some other things that pop up on here that I don't know if this is the time to ask or if we wait until they're here. But for instance, on page 5, where we look at the annual turnover range, and this may be a moot point because it looks like we're heading towards 2. But small caps, you would expect to be a higher turnover rate. And Riverbridge, for some reason, their turnover rate was low, around 15 to 40. So likewise, probably doesn't matter now if we go to 2, but I was just curious about that, if that's something that would be appropriate to ask you, or if that's an interview question later on directly for the company.
So I give my same answer that I always give on that turnover question. I'm not sure why we put it in our material for tax-exempt investors. It's not really relevant. It's relevant for taxable investors because it's the more turnover you have, if you're realizing gains, that can produce taxable income. That turnover doesn't necessarily mean full name turnover. Like, it can be trims. So the more companies you have, more holdings you have, we would expect a little bit higher turnover because they're trimming those names. They're not necessarily selling out of them. Riverbridge more concentrated, so generally that means they're going to buy and hold and not sell out of the positions and trim them. But it's really more relevant for taxable investors than tax exempt.
Very good. Well, I like the idea of the 2 for what you contrasted there, but I'd also, I was interested in the research techniques with Silvercrest. I particularly, I kind of like both approaches, bottom up and top down, especially in times like we're at right now. I just kind of value that somebody's watching in the landscape and not just what's on the balance sheets and income statements. So with that, that's all the comments and questions I had.
Okay, trustees, any other questions or comments? Jason, thank you very much.
Thank you.
I do have one thing. Does the down market expedite your gray hair?
No, that's mostly my children, and
Okay.
and they're up and down, and no correlation to markets, I think.
Okay, well, we thank you very much. Okay, any comments from the board, staff, or citizens?
Just going to say my book, All Weather Retirement Portfolios, published by Forbes. I've got a free copy here for you if you'd like, or anybody in the gallery if you'd like, so grab a copy.
Okay, thank you, Randy. If not, 11:03, we stand adjourned.